Well, my next guest was head of foreign exchange strategy at Citigroup and also Bank of America for 10 years. He's Robert Sinche. He's now the chief strategist at Lily Pond Capital. And Robert, thanks so much for being with us.
Good to be here.
Okay, so as you just heard from Sarah, I mean, we've seen this about face within the last several weeks. Is it all about confidence in the U.S. economy or what?
Well, I think it's a little of both. In terms of Europe, I think there have been some concerns about the stability of the single currency with some of the strains that are going on fiscally in Greece in particular. But I also think that there is some shift now in terms of expectations about Fed policy, and I think that's really starting to drive the dollar higher. We'd been in an environment where even as U.S. assets performed better, the equity market went up, the expectations were the Fed wasn't going to respond, and so it really didn't translate into a stronger dollar. And I think what we've seen in recent weeks is there are some expectations the Fed may respond to stronger economic momentum as we go through 2010. That, combined with a very short dollar position in the marketplace, I think has given us this pretty abrupt rally.
And those shorts, though, they're backing away now?
Oh, I think you've seen those shorts come down very substantially. You know, December is usually a seasonally weak period for the dollar. And so I think a lot of the short positions going into the month felt very comfortable holding those positions into year end. But as the dollar started to rally further, suddenly that squeeze really took place in the last few weeks. It does look like those positions are being wound down and more neutral exposure going into year end.
Right. Nobody wants to get caught on the wrong side going into the new year then. But Robert, very interesting, though. I mean, you know, if it is an anticipation in some ways of the Fed raising interest rates, that may not happen, though, certainly for several quarters, according to some economists. So are we going to see the dollar sort of bounce around, though, in this, you know, in these ranges, you know, before the interest rate rise, or are we going to see a pretty rapid acceleration?
I think we've probably seen the initial part of this move, 5% of the dollar index, as Sarah mentioned, pretty substantial move in a short period of time. That kind of got the severe undervaluation out of play. I think we probably range a bit now until we get more certainty, as you said, on the economic numbers and how the Fed's going to respond to them into the new year.
One of the other things we're also watching with the dollar is also the correlation with the equity markets and also commodities. Now, I know in the last several weeks we've actually seen that inverse correlation become more of a parallel move between all of those asset classes. So how significant is that for the dollar?
Well, I think it's very significant, again, because if you think about a rising equity market and a rising dollar, which has been counter to what we'd seen most of this year, I think the key link there, again, is the Fed. If the Fed was not responding to stronger equities because the economy was weak, then the dollar would stay soft even as equities rose. But if equities are rising and economic momentum is also improving, and then you get the Fed response, that's when the dollar can start to respond in a positive way.
Okay, and just very quickly, I mean, any sense, though, that a stronger dollar could impede or jeopardize economic growth right now, or no?
Oh, I don't think it's moving enough to have a really meaningful impact on the economy yet.